Hit the wrong button. How's everybody doing? Welcome to the Financial Thing live stream. It is Thursday, December the 11th. If you're in the UK, it's 7:30 p.m. here in Orlando, Florida. 2:30 p.m. You can see the sun is shining. Look at that. Blue skies. A little bit of a breeze. The camera is looking sharp. Is that new iPhone 17? I don't know the difference, but camera looks good, right? So I hope you're having a good week. Thanks for joining. Thanks for choosing to spend maybe an hour or less with myself and Holly, who is down there. She's still there, snoozing away as always. I have a Holly cam, but the Holly cam is not facing Holly at the moment. Yeah, so how are you guys doing? How are things in the UK at the moment? Sorry I haven't been here last week, dealing with some family stuff at the moment, so intermittently here, taking care of what's important in life. So I'm sure you understand, can't always be here. I did have some interesting conversations with people regarding peer-to-peer lending this week, so we're going to be talking about what is going on at Cufflink. And I'll kind of give you my thoughts to what I believe is going on. I know there's a lot of unhappy people out there at the moment with Cufflink, understandably. We always talk about how you have to really keep an eye on things in this business. It's a relatively raw sector, and things do change. As you can see, I've always said this, with peer-to-peer lending, things can change in just a day or just an hour. And we're seeing that right now with a company that many of us thought were very well established. And so I'll kind of go through what I think is going on there with Cufflink. And we'll do some investing talk. We'll do some peer-to-peer platform, little views, see what's going on there. LoanPad had a good article that they posted on that blog about the top 5 risks of peer-to-peer lending, which I think is worth a look. But anyway, if you haven't subscribed to the channel, some of you, even you faithfuls that tune in every week, are not subscribed to the channel. So if you could subscribe, hit that thumbs up if you can. I would appreciate it. You know the deal. I don't need to tell you. Thank you to everybody who is a loyal Patreon member. If you're interested in becoming a Patreon member, links in the description below. And appreciate your support, of course. Quick hi to everybody in the stream, future, past, and present. Invest24 is here in a dismal southwest London. I mean, it probably isn't right to even show you this picture right now. It's about 23 degrees here. This is why we suffer here in Florida with the miserable heat during the summertime. For this, 2 or 3 months out of the year, we get this pleasant, cool, mild summer weather. And you guys get that hopefully during the summertime in England. We don't here, but we get it during the winter for a couple of months, 2 or 3 months. That's why we live in Florida. Anyway, who else? Paul Bagworth is here from Kenilworth. Let me know if the sound's okay. I got new internet. It's supposed to be faster, running on Wi-Fi now. But let me know if you can hear me okay, if it sounds good. Norman P. is here in a very grey Sussex. Interesting. Did you know in America they spell grey Gray? I never really understood why. Ask me, have I seen the latest email from Fourth Way regarding Cufflink? Depends when you mean latest. Was that latest today? I've not seen it. Peter Vince, evening from Leatherhead, where we've had a couple of mild sunny days. Very nice. Dave Dawson is here. Mike Powell is here. Welcome, everybody. Nice to see you and everybody else who is watching, including Mr. Chimpo Naughty, the man himself. The Bitcoin King. Is that right? Are you the Bitcoin King? Yeah, Bitcoin. We'll talk about Bitcoin too. Bitcoin's just so volatile at the moment. Some big news, though, this week for Mr. Bitcoin. Picture and sound is better. There you go. Well, great. That's awesome. So glad. We are investing in the Financial Thing infrastructure here. We are making severe losses financially. I have not seen the email. We're making severe losses financially here at Financial Thing, investing in infrastructure. Let me see. We'll take a look at the email from Cufflink. Yes, I saw that. We are going to talk about what is going on with Cufflink. And yes, I just pulled up that fourth way article. It kind of goes along with the things that we're going to be chatting about. And yes, Cufflink is in trouble. I've seen that. Funnily enough, I did have a conversation with ex-CEO Narinder this week about Cufflink. He really, understandably couldn't really tell me much about it, but he did tell me a couple of things that I thought were interesting. I'm not really sure what I can share. Should I share? And I also saw Cufflink has a new investment opportunity available too, Shoreham's Lane, which is interesting considering what is going on over there. Yeah, anyway, let's get right into it. No point in standing on ceremony, as they say. So let's hop into a little bit of news here. Not really peer-to-peer, but this kind of makes me laugh. These things that these peer-to-peer companies make you go through once a year, where you have to certify as a certain type of investor. It literally is just clicking two boxes saying whatever you want to say. They believe you. You move on. But the FCA moves to loosen rules for wealthy investors. Imagine that. Imagine that the people would let you actually invest in what you wanted to without telling you what to do. The Financial Conduct Authority has announced plans to cut back regulatory hurdles for high net worth individuals, potentially widening the pool of investors available to access alternative assets and making it easier for firms to design new products. In a consult paper this week, UK regulator proposed clearer boundaries between retail and professional investors. Among the headline changes is a move allowing wealthy, experienced individuals with at least $10 million in investable assets to opt out of retail protections, streamlining how firms classify professional clients. There's one set of rules for the rich, right, and the wealthy, and another set for ones who are not considered 10 million pounds wealthy. I don't agree with it. I think you need to have things in place to protect people in a way. There's risk warnings all over, a lot of alternative investments. Can you wrap people up in cotton wool and stop them from doing something stupid? No, you cannot. I don't know that I'm in favor of having one set of rules just because somebody has 10 million in investable assets. Believe it or not, there are some people out there who are not exactly financially savvy, who are actually wealthy. Maybe they inherited it. So I don't know that having rules like that really makes sense, but we have to let the FCA do what's best for us as the people, right? Because God forbid we'll make our own decisions and make some mistakes. The FCA will not protect you in many cases. We have seen over and over and over again. But I think it's up to us as investors to do our own due diligence. And at the end of the day, that's it. If we don't do our own due diligence, we really have no one to blame unless we're being defrauded, which happens sometimes. Anyway, going back to the story, it says today's measures support investment risk culture right along the spectrum. They also draw a brighter line for professional markets defined by contracting parties. Bunch of word salad that nobody really cares about. The consult also highlighted industry feedback calling for greater differentiation between retail-orientated funds such as pension schemes and non-retail vehicles like alternative investment funds. Some respondents argued that the latter should be treated as eligible counterparties. What a snooze. The more I read that article, the more it's actually making me go to sleep. So we're going to go on. LendInvest October 2025 newsletter just kind of goes through what has been going on for the month of October. LendInvest seems to be pretty steady, I would say. They keep putting new investments on the platform, which I think, by the way, is probably one of the greatest litmus tests of how a platform is doing. If you look at companies like LHX who are not doing anything new, you say, I wonder what's going on with that company. Also, look at what happened with Cufflink. investments started to slow down. Then we saw the problems come down the line. But however, LendInvest continues to introduce new investments to the platform. So we had 7 investments posted in October, 132,000 average, so pretty small. Average return off at 7.54%. By the way, we're going to talk about interest rates because they've been dropping too. Average loan to value, 64%. Grand total of a little less than £1 million coming onto the platform. Now, let's go down here. How much is in enforcement? 5%. Not terrible. 7% out of term. We have now on schedule 80%, which is looking better. That has definitely increased. So I'd like to see those on schedule numbers keep going in the right direction. Typical targeted return 7.5 to 8.75%. Liquidity matched the cash flows of underlying loans. That's the one thing about LendInvest is liquidity for an investor is not great because you cannot exit out. There is no way to get your money out if you needed it, but that's one of the downsides. LendInvest continue to go forward on and on and on. Let's see what else here. That's a forum question. We'll hit that in a minute. Okay, let's just go straight to Cufflink because that's the talk of the town at the moment. What is going on with Cufflink? I'm just going to move this out the way over here. Of course, we had an email from Cufflink. An important update. If you have been living under a rock, you might not have seen this. Please read the following update about recent findings and changes to the Cufflink pool. Dear investor, we are writing to update you on several important matters relating to Cufflink pool. Our intention is to be completely transparent about recent findings and about the steps we are taking to protect your interests. An initial review identified 5 out of 237 loans in the pool were incorrectly labeled, and investors were not notified that certain loans were related party loans or SME loans, small and medium enterprise. The following terms are relevant to this update, to your RPL SME. The review also identified inaccuracies in the reporting over charges over some properties. That's a big boo-boo. Huh? For a small number of loans, the security held in respect of the loan is shares, debentures, and small and medium-sized enterprises, and this may not have been clear from the information on our platform. We acknowledge the importance of making accurate disclosures about all loans offered on our platform and apologize for these errors. The 5 loans which were not labeled correctly are listed there. We're working with the FCA to address this fully and completing a full risk assessment of the pool. We'll share the updated information with investors in the upcoming weeks. As a result of these issues, the pool is now closed to new investments, including all new investments, ISA transfers in, reterms of existing investments, which instead will be canceled and returned to your wallet. Your existing investments will continue into maturity, and any returns will remain linked to borrower performance. However, going forward, performing capital and interest will be repaid to your wallet as loans are repaid rather than being reinvested back in the pool. Pool, by the way, is auto invest for anybody that doesn't know. These steps are intended to run off the pool. When this is concluded, our current intention is that we will cease to offer the auto invest model. Big news, the issues above do not relate to the self-select investments. To continue our best practice review, we're also carrying out a comprehensive review of our due diligence process with the relevant teams to strengthen our controls and improve accuracy. We appreciate your understanding as we take these opportunities and steps before enabling further new investment opportunities. We want to ensure full transparency, improve our processes, and maintain your continued confidence in our platform. Wow. Now, I did read this email when it came to me on the 11th of, actually it came before, I don't know when that came to, let me see, 2nd of December. And I was kind of going through what was going on, the chit-chatter, what I had heard, what was going on in the forums, trying to decipher, what a mess this is. Now, I will say this, okay? I will say this. Now, I don't know this for a fact, but if you went through any company's records with a fine tooth comb and a magnifying glass, I'm pretty sure you'll find issues, right? And this is the lack of transparency, I think, that comes along with investing in a very raw sector that might not dot its I's and cross its T's the way that we would like. The problem with this situation is, first of all, the FCA, and the reason why this is happening, and I don't think this is very clearly stated by Cufflink, but Cufflink is closing the auto invest because the FCA has made them do that, right? And if we go to the FCA's website, you can look this up yourself. Go to Cufflink's page. You will see right here restrictions. There's two restrictions, one on the 15th of August 2025 and one on the 19th of November 2025. The first restriction, the firm must not, without the prior written consent of the FCA, onboard any new clients. And then on the 19th of November, the firm must close its auto invest product to any further money from investors and cease all lending, including any further drawdown of tranches on any existing loan facility to any person connected to the firm. More information. Let's see what it says. Doesn't really give you much more information. But that's pretty bad. That's pretty bad for two reasons. Number one, the FCA has either discovered things, maybe through an audit, maybe this is a Cufflink discovery. I don't know the answer to these questions. I don't think anybody does unless you work for Cufflink. But either they found things that were not correct, or the FCA has audited them and found things that are not correct. So what does this mean? Auto investors is no longer a thing at Cufflink. That's a big problem for them. It also means that confidence, if we go back to that letter that says we want you to be confident, we want you to have confidence in us. Maintain your continued confidence. Do you have confidence now? I don't. When Narinda left Cufflink, to be honest with you, that was when I first started thinking about, is this going to be a good place to invest long term? I didn't have any of this information back then. It was more of a gut feeling, and I told you this on the stream. I started backing out. I didn't have a lot invested through Cufflink anyways, but I started backing out. Unfortunately, I did re-up my 1 year auto invest product. I didn't put everything I received back in. I think I put about half in when it matured the first year after year one. So that is in there, but it doesn't really give us confidence about what has happened. And the mislabeling of the security of loans is a big deal. Because then what happens is I don't have much confidence now going forward that things are going to be done correctly. And why take the risk, right? I've always said this. If you have feelings of negativity towards a platform, you don't need to invest. And, if you can get your money repaid back, sit on the sidelines. I think this is a good question to ask Cufflink. How is this fixable? Why did this happen? This is a pretty big question, right? How does this happen and why does this happen? Who has done that? Who's watching over compliance? Is this a compliance issue? I don't know. It seems like pretty big missteps for pretty simple processes. I mean, having debentures, a small number of look at this. For a small number of loans, the security held in respect of the loan is shares and debentures. Shares in a medium-sized company are probably, in some cases, worthless. So that is not much of a security. I don't believe in debentures. Debentures are not good security. I've gotten burned on debentures on a loan that I personally lent to a SME myself. So I know that debentures can be completely worthless, as are personal guarantees in some cases. But mislabeling those things and not making disclosures about that is a big deal. So there's a Reddit forum about this, a Reddit, people saying this is bad, this should have been told about this. pretty angry. You know, some people mad at the FCA again. You know, like I said, the FCA is not going to protect you. They are not. This Fourth Way article comes out today. Didn't see it. Let's see what they said. I'm just going to have a quick scan through. I would imagine it's saying the same thing. FCA has forced Cufflink to close its auto lend accounts. Also, it's winding them down. Outstanding loans already down by over 1.5 million. Auto lenders were unknowingly lending to Cufflink shareholders, directors, and families without proper security. Neil Faulkner writes, I believe that most of the lending was not fully secured by real property that was owned by the borrowers. The FCA has now banned any lending to parties connected to Cufflink. So interesting that the connection that the people who owned Cufflink taking loans. When I used to go over there, it was very interesting dynamic. Because Cufflink originally started as, I believe, they were lending out their private money on real estate projects. So the fact now that there has been ties to people, whether it's family members or the owners of Cufflink lending out money, that's a problem. And also you've got this, this first loss thing that was always in place, right? Questions come up about that. Were they connected in that way? Were they lending money to people within the company? I don't know. Based on limited data and Neil's best guesses at Fourth Way, perhaps 6% of total amounts in auto lender and loans connected parties, and in other loans that are not fully secured by property. Cufflink or Fourth Way may uncover more. I'm speculating here, but it's possible the FCA closed the auto lend accounts, at least in part because bad loans in those accounts were not sold on at a discounted rate to new lenders entering the pool of loans. In other words, new lenders buy into the entire pool while paying for any outstanding bad debts as if they were healthy loans. They've received no discount to reflect the increased risks of any loan parts that they purchased that were suffering issues. That often evens out. Yeah, that's a very interesting point. If you were investing money into the auto lend product as I did, like you're re-upping, say, a 1 year or 2 year auto lend product, now you're putting money into bad loans. That's not good. That's not good at all. So as a consequence, FCA restrictions now on auto lend accounts, now they're being forced to wind down. I think this is really, really damaging to Cufflink. Just from a confidence level, I think once you do things like this, it's very hard to come back from it. So question to you, would you lend again through Cufflink now? I don't know that I would. Have to see some real big changes. And why take the risk? Why take the risk? One thing I always thought was, how are Cufflink able to offer, 9 or 10% on a 1 year auto lend product? It's a lot of interest. The developers will either need to secure future tranches of funds through Cufflink's self-select lending account or from other sources. This is a big problem. If you're a developer and you started lending through Cufflink with the belief that you are going to be able to get more tranches of lending as your development progressed, now that's not going to happen. Do you think developers are going to come back to Cufflink again if, let's say, they were supposed to get 3 tranches or 4 tranches and they get 1 and then they can't get the rest of the tranches? That's a big problem. If the developers are unable to raise additional funding quickly enough, it increases the chance of a project failure. That in turn increases the risk they will be unable to repay their loans to you in full. Perhaps a third of lending through Cufflink is in development loans. There is also a high risk of bad debt. Cufflink may not take on any new lenders. That's a big decision by the FCA. The one good sign from the FCA, the restrictions placed on Cufflink are severe and show grave misgovernance. However, the fact the FCA hasn't told Cufflink to stop all lending together is the one sign that it suggests it could have been worse. In my experience, the regulator normally tells providers that are beyond saving to stop all activities right away. This suggests Cufflink has a chance if it reacts with energy to all the FCA's findings. Self-select lending has almost stopped. So we saw that. We saw the loan pipeline just kind of dry up. Fourth Way one says that they believe Cufflink wants to ensure that enough lenders are still interested in funding loans. I think they have a big problem with that. I know of at least 18 Cufflink staff departures this year, many of them senior. That includes the CEO, that's Narinda. I'm sure there are more. I was told by a very good source, I'm not going to say who, that number is now closer to 25 staff members. So definitely more people leaving. A new head of governance and compliance joined the board in February, but departed a few weeks after the FCA restricted new lenders in August. A person in that role, in conjunction with the CEO and the board of directors, has the overall responsibility of preventing the issues that have come to light. A solicitor joined Cufflink in September as legal counsel. Oh dear, I mean, what a mess. This is just a mess. A good article, though, by Fourth Way. Cufflink didn't reveal any of this Fourth Way or lenders until it seemingly had no choice. That is the biggest problem that I have with this entire situation, is lack of transparency. There's nothing that has been said on Cufflink's communication about why this happened or the fact that the FCA has restricted them in certain ways. Now, the problem for them is if they tell investors that they've been restricted by the FCA, it's kind of like a run on the bank, right? Where if a bank were to tell their customers that they have severe problems, what's going to happen is all the customers are going to run into the bank, try to take out their money, and the bank will probably end up collapsing because they don't have enough liquidity to pay out all their customers. Because if you know, by the way, the banks they're not forced to hold all of your money on deposit to be able to pay you back. I think it's only a small percentage. Cufflink doesn't really necessarily have a ton of liquidity, but they do have a secondary market, so if they were to come out and tell their customers that they are being restricted by the FCA, what's going to happen is people who have self-select lending and put those loans up for sale, and people will probably run for the exit. So they're in a difficult situation. Fourth Way goes on to say, in August, I noticed there were almost no new lenders. I chased Cufflink for an explanation for 6 weeks. I eventually received a response that was framed very positively and simply a commercial decision that involved a temporary pause. Cufflink did not explain that the FCA had restricted new lenders. Here we go. That was a quick and easy way for it to lose my trust in what it tells me. It's been more than a week since I asked for a meeting with 2 of its directors. They've told me they will not be able to find an hour for me until sometime in the new year. What this means for Cufflink's future, I don't know. Whether Cufflink can regain lender trust, or if it's already done enough in the background to convince the FCA not to restrict it any further. Could Cufflink's platform close? Yeah, of course. Absolutely. How are the outstanding loans performing? We don't know. What Cufflink needs to do now: own their mistakes, be transparent, get on board with the fixes. I'm not going to go through all that. What to do now? Neil at Fourth Way says, for existing lenders wondering what to do, it's never a good idea to make snap decisions or judgments when investing, including money lending. It's still the time to wait more info, collect facts, and decide how to proceed. But we can't give Cufflink much more time. Yeah, I mean, personally, if I had a lot of money in self-select in Cufflink, I'd be very, very wary about the situation there, and I would probably consider putting that out on the secondary market and getting out. You can always get back in, right? You don't need to go down with a sinking ship if it's going to sink. You jump off the boat, paddle around in the water a bit, observe from a distance, and if things get sorted out and they look okay, you can always climb back on the side of the boat, get back in the boat. I just don't think there's any need to take unnecessary risk. Cufflink is it's a shame because the first few years, I think we all had pretty good experiences, but like I said, when Narinda left, I red flag big time for me personally. So, what do you think? Let me know in the comments. What's your plan of action? What do you think's going on there? What do you plan to do? It's unfortunate because it seems like in the last few months we've had some blips on the relatively quiet peer-to-peer radar, which our sector doesn't need right now. You know, the last thing we need is another company, one of the bigger ones, closing their doors because of a snafu, because of mistakes, because of things that should have been transparently explained to people who are lending money. And there could be another big dent into the peer-to-peer lending industry. I surely hope not, but as somebody who's been through the collaterals and the money things and the lendies, I don't know that I can take another hit in the head from one of these companies. You know, my confidence would certainly be waning at that point, which is very sad. How long we go for half an hour? Okay, let's run through everything else. I'll go ahead and read your comments at the end about that. Good, timely article posted in November if you like reading about risks. And I like that LoanPad. LoanPad has always been that company. You know, Louis has always told me, he's always said, be very careful of every one of these companies that you invest through because things can change so fast. And he said that even about his own company. He said, you should be careful. Do your due diligence and really be aware of what's going on. And sometimes you just can't be aware. I mean, the Cufflink example is a great point and a great example of how sometimes we can't be aware of what goes on in the background because we don't have access to that information. And even me, you know, I had a good direct bat phone pickup with Narinda, CEO, and you know, nothing. I didn't know anything about this. So there you go. 5 risks in property-backed peer-to-peer lending and how to mitigate them. I think there's actually 6, but I'll tell you what the 6th one is. Borrower default risk, obviously. Lender borrows money, they don't repay it. Big risk. Property market risk. Of course, the property market goes down. Developers can't pay because they can't sell their properties for enough money. That's your property market risk. You got liquidity risk. Unlike listed shares, peer-to-peer loans are not instantly tradable. So if you need access to your money before the loan term ends, it can be difficult. Case in point, some of the peer-to-peer lending companies don't have secondary markets. Cufflink does have the classic account, which allows for daily withdrawals. Premium account, 60 days notice. By the way, I'm testing that out. I put in to move money from premium to the classic account back in the early November, so I don't foresee an issue. And then you got platform risk, of course, that we've had with Lendy. Collateral, platform goes down, takes your money with you. And then economic risk. Broader economic conditions such as high inflation, rising interest rates, slowdown in housing market can affect borrowers' ability to repay. One thing I was going to say was number 6, the risk number 6 is, and Cufflink again, example, they have not disclosed everything transparently. So what you think you're getting security on a property-backed loan, you may not have. LoanPad, I don't have so much worry with that, but we've seen it with, say, for example, collateral, that they just weren't transparent. The things that we thought to be true were not true at all. So that would be risk number 6. It's a good article, though. If you want to read that, go to LoanPad's website, loanpad.com, and click on that blog. Let's talk about some other things. Should we go to the mailbag? Let's see. Let's go through. Trading 212 portfolio. It's done a little bit better. It was pretty volatile right now, running at 26,700. What's going on? NVIDIA, if we take a look at the week, so let's take a look at the monthly. Down about 9% for the month, but we're up a little bit this week. Still in the green on that one. Strategy has been killing us. We're at 46.57, down 3,300 pounds. Yeah, not great. Amazon up 22%. Tesla up 20%, so doing okay with them. Now, big one, we hit one here. Photronics up 57.6%. This was a stock that a lot of people had not heard of. I did a little bit of research, identified something that could have been a gem. We're up 72% in the last month. You can see here, average price bought in was $24.66, so 18 pounds. And now we're sitting at $38, so pretty good. When did we have this big jump? It was on Wednesday. We had a nice jump on Wednesday. So, yeah, look at that. Almost 60% in a week. Probably a good time to sell. This is the plight of the average share investor who tries to pick stocks. So while Photronics has done well, it gets completely obliterated by the bad strategy performance that's down $3,000. So we've made about 918 pounds on Photronics, but lost 3,300 on strategy because we're not equal weighting these investments. I figure long run strategy will be a good runner. Is that going to be the case? I have no idea. So went much heavier into strategy at one point. I think I had about like 8,000 or 9,000 in there. We did sell some off. But Photronics was a smaller bet because I considered it to be way more risky. Iron, 2,100 in Iron right now. We're down 20%. Nebius, we're down 23%. Rocket Lab has had a nice little comeback, 40% up in the last week. And Cipher Mining down 3%. So just really a general mixed bag. Probably would have been better just putting it in the S&P 500 and not trying to do this kind of thing. But this is what the Trading 212 portfolio is. It's attempting to create our own portfolio to see if we can outperform the S&P 500. Why these stocks? Well, just looking at the future, right? So obviously NVIDIA, AI play. This has been the rage. We know AI is huge right now, so NVIDIA making chips and GPUs. Strategy is a Bitcoin play. If you believe in Bitcoin in the long run, strategy is a good play possibly for that. Amazon, kind of a no-brainer, right? Where does everybody get their Christmas gifts from? Tesla, again, no-brainer. In my opinion, electric cars, they make good vehicles. Eventually they're going to have full self-driving. Unsupervised, which will come up with a subscription of $100 a month. I'm sure it'll be released in the UK at some point. I'm a believer in that technology in the future. Who knows? Photronics. Yeah, Photronics is, I don't know, it was a little bit of a kind of swing in the dark. But again, what does it do? It's to do with photomass that I'm using manufacturing of integrated, I can't speak, let me drink, hold on. Integrated circuits and flat panel displays in Taiwan, Korea, Europe, and China. Transfer circuit patterns onto semiconductor wafers. It's technical stuff, electrical, optical components. Iron and Nebius and Cipher Mining. So, as we've seen, AI has become really big, right? Well, the play with these stocks is AI, they need places to house these computers. I mean, hundreds of thousands of GPU computers have to be put somewhere. And these companies have access to the space and the electrical power to house thousands and tens of thousands of GPUs. Places like Microsoft are going to need, Meta, Tesla. They have to put these AI computers somewhere. And these companies, while they originally, some of them like Cipher Mining was originally a Bitcoin mining company, they have the infrastructure to be able to house GPUs. So that's what it is really about. for that. Rocket Lab, what is Rocket Lab? Rocket Lab, we're talking about the future in space. There are some grandiose ideas that eventually space will have data centers in space. Imagine that, which actually is not really that crazy if you think about it, because we already have space internet through Starlink, which is a pretty damn good idea, because for anybody that's been on their phone and been in a dead spot on their phone and not been able to get data, Starlink is going to provide data to cell phones and mobile phones, where you could be anywhere in the world and get internet access on your phone, in the middle of the ocean or wherever you need it, in the middle of an Africa plain. So Rocket Lab is going to be a part of building, not necessarily building, but sending rockets up for data centers in space, which again sounds crazy, but if you think about the future, maybe not such a crazy thing. So kind of a swing also on that. But those plays are really AI based. I don't know if they're going to work out or not. I would say not necessarily super high risk reward, but we're not betting the house on them. As you can see, they've taken a hit from their highs. But overall, the portfolio is doing okay. We are down 6.4% for the last month, about £1,800. So if we looked at the S&P 500, let's see, here you go. That is down just, hang on, how much are we down on that? If we would have been investing 1 month, 1%. So this is the risk and the volatility that is trying to stock pick. And there you go. Let's go to the mailbag. Good questions this week. Happy holidays to you and your family. Regarding interest rates falling, do you think rates will continue to stay low? I've been considering adding to my peer-to-peer lending allocation as the sector looks more attractive now. What do you think? Yeah, it's interesting. As interest rates start to drop, people look for more fixed income type products, such as peer-to-peer lending. It's happening in the UK. We got the Bank of England rate now at 4%. In the US, we just had a rate cut of 0.25% yesterday. You can see here, look at the interest rate history, super low from 2009 to stimulate the economy after the great financial crisis, gone back up now, and now we've gone back down from 5.33 down to 3.88% now. So if you're just putting money in a high yield savings account, you're going to get about 3.5 to maybe 4% if you're lucky. So peer-to-peer lending becomes more of a viable place to get fixed income, because it's not easy to get 4% plus nowadays, unless you're going to take some risks. So places like, if we look at House Martin here, you can get 7.4%. I think this release that they're going to do is until 2030. So 7.4% looks a hell of a lot better than 4. So maybe you're just going to see more money rotating into places like, these peer-to-peer lending products. Trying to predict whether the interest rates will stay low. I think this is a good indication when rates start getting cut that the economy is in some trouble and needs stimulating. So rates will stay low as long as the economy struggles. For how long? I don't know. But I think peer-to-peer could be a good spot. But again, you have to think about diversification. Is that a smart move? Right? You can also look at places like Blend. They offer, if you can actually snag any of these deals, you can get 9% on some of these deals, 10%. Look at that, 9.5%, 10%. With some risk, if you're willing to take the risk, the rewards are out there, and 10%, 9% is a hell of a lot better than a 4% interest rate that you're going to get in the bank. It's a big difference. You are taking the risk, though. You're not FSCS protected. Speaking of that, so yeah, answer your question. I don't think it's a bad rotation to make as interest rates start to fall. I think you're going to have another rate cut. I wouldn't be surprised if the U.S. gets down to 3.5%. if it doesn't see much happening in the economy next year early, and the UK tends to follow suit. FSCS protection limits have increased to 120,000 from 85,000 pounds. So if you do want a lot of cash sitting in the bank, I'm not sure why you would, but if you do, you can get that covered now up to 120,000 squids. Let's go on to another question. Hi, Lawrence. Hope you're well. Are you not live streaming anymore? I am. I'm here right now. Yes, I am. Percy in Stockport. Why don't you like investing in the good old FTSE 100? I'm all for supporting British investments. I've been a long-time investor since the 70s. I think you should give the FTSE 100 tracker a look. Cheers, Percy in Stockport. Yeah. I mean, I just look at history. So let's go look at a chart. See here the blue line. The lower one is the FTSE 100. So yes, if we looked at 1 month chart, look at that. FTSE 100 is down 1.47, but we'll start to zoom out a little bit. FTSE actually had a good year. Let's go year to date, 6 months. Year to date, look at that. Year to date, the FTSE 100 has finally beaten the S&P 500 by 0.25%. Let's go to the 1 year chart, Percy, if you're watching, hopefully you are. 1 year, look at that. The FTSE has beaten the S&P 500. It's plus 17% versus 13.4% in the S&P. But now here comes the problems when we zoom out, Percy. And then they say when in doubt, zoom out. 5 year, look at this 5 year chart. The FTSE all the way down here, struggling, plus 48%. The S&P, plus 88%. And then it gets worse the more we zoom. Oh dear. Oh dear, look at the gap. That top line is the S&P. Now we're in 2022. This is 2019, and it just starts to get worse and worse and worse and worse and worse. Until the ultimate gut punch when I click on all. S&P 500 plus 149,000%. The S&P, the FTSE, look at this line. I don't know if this is actually accurate. I think that's a bit of an extreme view, but if we go back 5, let's maybe go back 10 years. Let's go back to the year 2000. Year 2000. The FTSE 100 is now up plus 44% from the year 2000. There's the S&P 500, 613. If these numbers are accurate, which I think they are, right? But this has been the problem, Percy, that the FTSE 100 has always lagged behind the S&P 500. And that's simply why. There's just not enough companies that make up the FTSE 100 that are going to outperform some of the big U.S. giants like Apple and Amazon and Google. It's unfortunate, but that's just the way it is, and that's why I choose not to invest anything into the FTSE. Let's have another mailbag. Long-time watcher of your YouTube videos. Thank you, Oliver. I've learned a lot and appreciate all the news and opinions, so keep going. I'm trying to keep going. Selfishly, I wish you would put out more content. You know, it's very, very time-consuming putting out content. I do what I can. Oliver says, I've recently been dabbling in Crowdcube investments. Have you ever? What are your thoughts? Happy Christmas. Happy Christmas, Oliver. Crowdcube. No, I've never. I have not purchased one Crowdcube investment. You can. You could invest in Wise Alpha if you wanted. They are doing a raise on Crowdcube. They're trying to raise some money. They want you to invest. You can get a 30% discount to the next round via a 6-month equity convertible. Why would you want to? It's a good question. Do you believe in Wise Alpha? You're basically investing in an SME directly. Here's why I don't invest in things like Crowdcube. Number one, there's hundreds of investments. I do not know which company is going to do well, which one isn't. For example, Nothing. Nothing is a London-based consumer tech company. They did a series of raises at a $1.3 billion US valuation. They raised 3.6 million pounds, almost 3,000 investors, right? They have a discussion forum. I think this is a good place if you ever want to find out. And by the way, if you ever want to find out anything, go to the forums and read. This is one of the comments. All this whining about the share price being static. It's pretty pathetic, guys. When I read nonsense about nothing, ripping off investors, blah, blah, blah. Do you not know that most startup investments fail or deliver just a fraction of what was put in? Do you know that venture capital investing is about trying to find the tiny handful of 20 to 100 to 1,000x baggers that deliver all of the returns? Many go to zero. Unless you are very, very good at figuring out the future, which I am not. Investing through Crowdcube into these companies is very, very risky. A lot of times, you're probably going to lose money. Some of these Crowdcube investments have gone to zero, right? But there are plenty of opportunities out there if you want to have a dabble. That is not something I want to be a part of. Because I think I'd rather have a stab at stocks on the open market that has great liquidity. I can do more research. There's some history there. But this is just not for me. Now, the only one benefit I would say of doing something on Crowdcube is you can do an EIS, which is basically shares that you can buy which are exempt from inheritance tax. Very, very risky, though. Very risky. I personally wouldn't do it. This guy has only raised 34,000, trying to raise 150 grand. Eventually, just the money runs out, right? The money runs out. There is only a certain amount of money that people have to invest into these startups. So it sounds very sexy, though, right, to be able to invest in startups. But personally, not for me. Do your own research, not financial advice. Blah, 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 blah. I'd be interested if anybody in the chat has actually invested in a Crowdcube project and made money off it. And if you have, how many other ones have you invested in that you haven't? Has it all balanced out? Does it look like my trading 212 portfolio where I've lost $3,000 here and made 1,000 here? Maybe it looks like that. I think that would be realistic. Let's do a little Bitcoin news. We had a big announcement. U.S. bank regulator says banks can act as crypto intermediaries. Banks will be allowed to act as intermediaries on crypto transactions. It's the latest step by the Trump administration to narrow the gap between traditional finance sectors and crypto activities. Of course, Mr. T has some vested interest in this kind of stuff. The Office of the Comptroller of the Currency issued new guidance saying that banks can engage in what are known as riskless principal transactions that involve crypto assets and would not receive scrutiny from the regulator. In such transactions, banks effectively act as brokers, buying assets from one counterparty while simultaneously entering into transactions to sell those assets to another counterparty. The bank does not hold on to any of these crypto assets in inventory as part of the process, except in rare circumstances. So basically, they're like the middleman. They're the eBay. Buy it now. Somebody wants to buy a crypto asset, they'll facilitate that. It's probably big amounts of money, and they're just helping that transaction take place, plus take a cut. But it does bring some validity maybe to the crypto space. Let's have a look at the Bitcoin price right now. $91,211. So still somewhat volatility existing. Where is my coin market price? Cap. There we go. Yeah, so, nothing new. Volatility is your friend in some cases when it comes to investing. Yeah, so there you go. That's the news. We're going to take a look at some of your comments. Let's see what you got going on. Thank you so much for joining, by the way, and thank you for hitting that thumbs up, as I know some of you have done. Sunny days. Yeah, look at the weather. I mean, isn't that just glorious? Look at that. Not a cloud in the sky. It's amazing. Yeah. It's a beautiful day. Beautiful day to be alive. We had to be thankful at this time of year. Christmas streaming probably will be few and far between. I got family coming into town. What's the date? We might get I say one more streaming maybe next week. Stay tuned. Check your emails. And then we'll probably not do anything for the rest of the year. Might be the last stream next week. We'll see. Thank you for saying that the sound is good on the stream. Mark Mason is here. Welcome, Mark. It's been a while. Stephen Hale in Nottingham. Concerning with Cufflink, as I have money there in AutoInvest, they've not been informing us. Could they be liable? Which is the first step in the wind down. Yeah, stay tuned. I don't know the answer to those questions right now. We'll see. LA checks are doing new loans as well as the mortgage bonds and some private office stuff. Fourth Way published an update about Cufflink today. Yeah, we went through that. Cufflink withdrawals are taking forever. I've waited 9 days for a withdrawal. I did a withdrawal today. I'll keep an eye on that and see how long it takes. I've heard that. Yeah, some people have been waiting a while. That's not good. You know, that means that they have a lot of withdrawals they're trying to process. Hence the run on the bank type thing. Yeah, I agree 100%. Mike Powell. I don't know why I was continuing with the view of the outside. Transparency, no mention that the FCA has ordered the shutting of the pool, barred new investors and other bits. 100% agree. They should mention that, but they won't. Dave Dawson says, I think it's wind-up time. I've certainly lost confidence. I felt like the email was a bit tippy-toeing around some of the major issues. So, Cufflink's reputation is taking a big hit this year. I agree. Mr. Helium's auto lens seemed too good to be true. Quotes rates above what you get for individual loans always looks unsustainable. Is Natalie Weeks still a Cufflink now? Safe hands. I asked Cufflink in August. They said she was still there. Had no plans to leave. Should we Google her? Should we see if she's still? Let's have a look. Natalie Weeks. Huh. Is it the same Natalie Weeks? We got to find the right one. Let's put in Cufflink here. There she is. According to LinkedIn, she's still at Cufflink. There you go. Can I invite somebody from Cufflink to appear on your live stream for Q&A? Yeah, sure. I'll try. Probably won't happen till next year. Yeah, I'll send out an email. I'll see what I can swing. Question is, why didn't Arinda leave? There were issues before with auditors raising questions. And from my opinion, and what I've been told, that was he didn't think there was any issues at the time. They just had differences in pass forward and what the company wanted to do versus what he wanted to do. He's usually pretty honest with me. He would tell me, I think, if there was issues. Pulling out of crowd property. I've had a few wins, but quite a lot of write-offs. On paper I'm up, but who knows the future. I presume CrowdCube, right? Too soon to say. I've invested in Wise Alpha on CrowdCube. I invest in Wise Alpha and receiving good returns. Okay, there you go. I think that's going to wrap it up today and this evening. Thank you so much for joining. Keep your eyes posted on the email for stream times next week. I don't know what day it's going to be. Juggling the holiday stuff and whatnot. But yeah, thanks so much for joining. You have a wonderful week, whatever you have planned for the weekend. Very much love goes out to everybody who tuned in. Thank you so much. Please tell your friends and family about what we're doing here at Financial Thing. And that's all I got for you. Catch you on the next one. Take care. Bye-bye.